All right. Good morning, everyone. I don't know if it's the fact that the other sessions went a little long, or no one wants to talk about the economy, but you guys have chosen the right room. The economy is the most important thing to be talking about, especially right now. Coming up with a title for this, they called this Georgia's Innovation Economy. But what we're going to be trying to go over today is what's happening in the economy, because where we are in terms of the cycle has a huge impact, of course, on business and what's happening in the world, in the U.S., and specifically in Georgia and here in Atlanta. We also have trends in the economy that are episodic. And we're in the middle of a major one right now with the coronavirus, and what are the implications of that and how is that impacting things. In fact, this year is looking to be a year that has a lot of strange episodic events, all occurring. And then there's long-term changes that are happening in the economy that can influence what exactly happens in business and even in our own consumer lives. So, 2 hours is not enough to give you a full-blown view of everything, and 30 minutes to give some time for Q&A is even more aggressive. But what I'm going to do today is walk you through the economy. I'm going to walk you through some insights into the automotive business, which is the industry that I'm focused on, because it is a place where major technological innovation is actually causing massive disruption that I would say in 10 to 15 years will radically change something that has been a common and boring part of our lives for years, vehicle ownership and driving. And then we'll speak specifically to some important data about Georgia and Atlanta so that you can see the perspective of what the future economy likely looks like here. I'm the chief economist of Cox Automotive. If you're not familiar with Cox here in town, one of the largest businesses, but it's privately held, so it doesn't quite get the attention that Coke and Delta and UPS and a few others do. We have over 50,000 employees worldwide. Cox Automotive is one of the major divisions. Cox Automotive, we do everything but make or sell cars directly. We run the websites Kelley Blue Book and Auto Trader, which is the way most consumers interact with us. We own Manheim Auto Auctions, which is the largest wholesale source of vehicles in the United States. About half of the market goes through Manheim each year. And we have an enormous Manheim auction just down by the airport. And then we also are in the finance business and software business. So if you go into a dealership, or if you happen to work for a dealership, chances are you're using one or more of our software, or our software is touching you when you go through the purchase process or even get your vehicle serviced at a dealership. I actually, though, have only been at Cox for 3 years. I spent over 20 years in real estate and construction, and what attracted me to automotive was seeing the disruption, but also being a part of Cox and having a tremendous amount of data to work with. So even though automotive may not sound like an innovative place, there is a lot of money and investment going into the innovations, and we'll talk specifically about that. But let me start first with the economy, because I figure a few of you are in here just to hear what's going on with the economy, and I'm fresh out of attending an economist meeting at Harvard yesterday, where we were getting briefed on what was happening with the coronavirus likely impacts. Before all of that started, we were basically seeing U.S. economic growth slow down, but it was looking like we were going to have a solid year this year that was pretty much on average for the last 10 years. This economic expansion has been the longest in history, meaning we've gone the longest period the U.S. has come in not having a recession, which is now over 10 years. But this expansion has only seen about 2% growth. And so at the beginning of this year, expectations were that we would be right at that average or a little bit below it. We had seen 2.9% growth back in 2018 when tax reform was really causing business investment and consumer consumption to tick up. But by the time we got to the third quarter of 2018, that started to reverse for two reasons. Interest rates were going up, and the White House decided to go after trade with tariffs that suddenly froze the success that was happening in manufacturing, and business investment started to slow down. Last year was a bit of a roller coaster, and I would argue that some of the, we ended up averaging 2.3% growth last year. Some of the quarters looked better than they really were, and especially the fourth quarter of the year at 2.1% looked like the economy didn't change at all. But underneath the data, what caused that 2.1% was actually math. It was accounting related to the way that GDP looks at net exports and inventories. And usually those things reverse in the following quarter. What was concerning was that consumer spending continued to decline as the year progressed. And I'm going to show you a little bit of insights of why the consumer is purported to be very healthy, but actually there are pockets of the consumer that isn't so healthy. And it's very relevant to many industries. But also business investment turned negative in the second half of last year as trade and concerns about the future really caused manufacturing to go into a manufacturing or industrial recession, meaning that that part of the U.S. economy has not been doing well. But then the question of are we headed towards a recession comes up. Well, the good news is just because we're the longest expansion in history doesn't mean that we're due for a recession. That's baseball speak. Go over to SunTrust, or should I say Truist Park, for that kind of nonsense. The odds of a recession are more reflective of the trends and what's going on. But we did see the odds of a recession spike last summer. This is just one way to chart and measure the odds of a recession. But if you look back historically, the New York Fed's index has been pretty accurate, meaning whenever that index spikes, we typically then see a recession. That's what's in the gray bars within 12 to 18 months following. And principally what was going on last summer was the yield curve fully inverting, and that was a very kind of critical component of this metric. But then, after we got past August, the odds of a recession kept falling in every subsequent month. But in January, we did a U-turn and the odds started going up. And the consensus discussion from the Economist I was with yesterday is that we probably are close to a 40% chance of a recession this year. And frankly, now it all boils down to exactly what happens to the coronavirus in the U.S. and if we have more outbreaks. So we'll have time in the Q&A to get into the coronavirus and what that actually might mean. But in terms of my discussion with the Cox family or our leadership or key clients is we have to have the view of a recession kind of on your radar and to be prepared for what the recession means. But actually the recession can often be a catalyst for innovation to move into the next level, because typically there's a fairly substantial amount of capital investment and business transactions that happen in a recession because all the prices that had gotten out of whack, and the automotive business is definitely one of those, that there's been very little M&A going on in automotive because everybody has too much of an inflated opinion about what their dealership is worth, for example. And as soon as things start to turn, you suddenly see people coming down in valuations, and there's typically a lot more activity. So in some ways, I would argue that well-positioned businesses are sort of praying for a recession to happen in many industries. It is not likely that if we have a recession, it's going to be anything like the last one we went through. If you look back historically, there's two types of recessions. There's bad ones, and then there's not so bad ones. And the consensus from all of the economists I know and work with is basically we would be looking at a 6 to 9 month downturn, a bit of a reset, and it would impact certain industries and certain parts of the countries more than others. And when we end with Georgia, I'll highlight what Georgia's risk might be. So the job market has been the strongest part of the story. And that story continued to be strong in January. We get February data on Friday, and a lot of attention is going to be focused on those numbers. It is very likely that the numbers are still going to be solid in February because the effects of the virus really aren't playing out in the leading indicators we see about consumer activity. For example, we got new vehicle sales yesterday, and new vehicle sales were at a stronger pace than we were expecting, slightly above our forecast for the year. The consumer continues to buy. However, February is not a big month, so a lot of that is seasonal adjustments that's happening in the data, and clearly a lot of variables are changing. But the headline unemployment number actually ticked up in January to 3.6%, and it was because labor force participation grew. More people are coming back into the labor force that had fallen off. It's generally a very positive thing, and so the consumer continues to be the strongest and most important part of the market. However, as I mentioned to you, we can see in the GDP data that consumer spending is decreasing. It's still, in terms of its growth, it's still positive, but it's not growing the way it had been before, and it's actually no longer keeping pace with income growth. So something is making the consumer become either less conservative or less in a position to be able to transact the way that they were, especially 2 years ago. It's not yet reflected in consumer confidence, and this is another one of those things you have to caveat for the month of February, because we got consumer confidence data last week, and we got the final data from the University of Michigan on consumer sentiment, and both had those indices of how consumers are feeling up slightly in February over January. I've chosen to show you what that's looked like monthly back to 2018, because when you filter in on this time period we've been, you can see though that consumers have been on a roller coaster ride for much of the last roughly 18 months. Because in October of 2018, we were at an all-time high, or actually technically in the way that this data is collected, an official 20-year high, going back to 2000 for consumer confidence. But you can then see that we went through periods of that going up and down in pretty substantial swings almost each month. And so if you look back, the stock market had similar swings occurring over that time that can influence consumer attitudes and behaviors. There was a lot of more negative politics. Impeachment process was influencing a little bit of that. But it really looked like we were through that period and gaining momentum. We had the phase one trade deal signed with China in January. So January, we ended last year on an upward trend, but not quite back to the highs. And then January saw it increase, February saw a slight increase. All of the data in February behind this and the consumer sentiment survey were collected prior to all the negative news about the virus and prior to any of the stock market sell-off. So you can pretty much guarantee with what's been happening in the stock market that consumer confidence will be down in March. I pay close attention to some underlying data metrics in that too, and your industries actually might have some underlying components. I encourage you to dig into it if you're interested. So for example, in automotive, there's a question around, do you plan to buy a vehicle in the next 6 months? And so typically there's a strong correlation with that blue line and the gray bars, meaning when people are confident and confidence is growing, there tend to be higher plans to purchase a vehicle. But you notice in the last 18 months, that too has been on a violent roller coaster ride. It's got some noise in it because of the sample of the survey and the percentage of consumers in any given month that are planning to purchase a vehicle. But to frame it for you, in May of last year, we hit an all-time high in the history of the data for the percentage of households planning to buy a vehicle. But by October, it was at a 5-year low. So something was really making consumers really change their attitudes about the future. And I would argue a lot of that had to do with credit. And credit is the part of kind of the U.S. economy story that I'm most concerned about outside of the coronavirus. We can see some of the challenges happening in auto loan severe delinquencies. So what is an auto loan severe delinquency? It's when a consumer is behind 60 days or more on their auto loan payment. And on this chart in red, and it's measured on the left-hand axis, is the subprime consumer, a consumer who has a FICO score under 620. And then in gray and on the right-hand side is what the overall total market, all auto loans, on what the delinquency rate is. Notice there's a clear seasonality pattern to this data, that sawtooth pattern. And it's because we consumers spend a lot of money in the holidays. We tend to get behind, and guess what changes come March? Tax refunds. And we reset that pattern behavior, and then we start that game all over again as the year progresses. That's what gives us the sawtooth. It's even more pronounced for subprime in terms of living on the edge, doing too much in the holidays, and then waiting for that tax refund check. And we are in that season. The bad news on the subprime delinquency rate is starting in October of last year, and each subsequent month since then, and we have data through January, the delinquency rate was the highest rate that Equifax has in the history of the data, which goes back to 2006, which means that on a percentage of loans for subprime, there's a higher rate, higher percentage than even we had in the Great Recession. And we have a higher number of loans today, so it quite literally means there are more subprime consumers than we've ever had behind on their auto loans. There are two interesting positives from this, though, that we aren't seeing those delinquencies turned into defaults. They are not converting into repossessions, and some of that might have to do with the lenders being more willing to work with them. Although I had some interesting conversations at the NADA, the National Association of Automotive Dealers Association, with some lenders, and they had a theory that it's actually driven by millennials. And millennials are overrepresented in the subprime data, and why this is classic blame it on millennials. But it's quite simply that when a consumer falls behind 30 days or more, the lender really wants to keep that person in that loan and work with them to see what their circumstances are. Well, millennials don't like answering the telephone. And so the usual behavior that might get the 30 contained at 30 and not going to 60 may be a reason that we're seeing an uptick 30 to 60 and not translating into defaults. And then in aggregate, while we are seeing an increase in the delinquency rate, it's not setting records. We're not back to the numbers we had during the Great Recession. But to me, this is a clear sign that and when you look across the full amount of data, I believe that younger consumers, consumers who happen to be renting rather than owning homes, consumers who are more likely to be subprime, are in less of an ideal financial situation than the aggregate data seems to convey. And so as a result, the spending behavior and some of the reasons why we're seeing consumption slow down is because some consumers are really tapped out and can't do any more. And that relates to then lender behavior, because one of the ironies of what we've seen as the Federal Reserve has been cutting rates, and notice this slide, I gave it to TAG last week, and it's already out of date in the headline, because what happened yesterday? The Fed did move, surprisingly, and cut rates ahead of their meeting schedule, which the last time they did this was in the teeth of the Great Recession. But what happened when they cut rates last year, and by the way, this is what happened yesterday too, we didn't really see automotive loan rates change all that much in aggregate. The aggregate number and what's advertised is the gray line. It barely came down as the Fed was cutting rates. But then when we separate real loans that are being made into what I call super prime, that's the orange line, people who have a FICO score of 760 or higher, we did see that's the green line. We did see their rates come down almost exactly with what the Fed was doing. So the lenders were fine with low-risk borrowers and basically passing along their lower cost of funds, and the consumer was able to purchase. And in fact, subprime, super prime, people with really strong FICO scores were the bulk of growth that we saw in auto loans in 2019. But for subprime, the opposite happened. Those rates not only didn't come down, they went up by 240 basis points. We ended in December with the average subprime new vehicle auto loan rate at 18.9%. So it was absolutely sending a message that this is a risky borrower. And when you do the simple math of what a new vehicle costs today, it essentially meant that subprime borrowers were pushed out of the new vehicle market. But the positive for automotive is it's made the used vehicle market even stronger. And so as you think about the Fed's cut, and the implication is this really going to change behavior, what we saw yesterday and what we believe is going to happen is that we're not going to see substantial difference, especially for the average consumer and the subprime consumer in terms of that math. And affordability, I would argue, is one of the kind of metrics that's telling us what disruption and change in automotive is really going to do to the future in terms of changing behavior. This is not the days of Henry Ford, where the average household can afford a Model T. We've basically reduced the pool of consumers that can actually afford a new vehicle. And because not only vehicle prices are up and have been well outpacing inflation for this last decade, we also are in a scenario that interest rates vary pretty dramatically by what your credit is. As I mentioned, the average subprime was almost 19% in December, and it's even higher now as of February. But when that translates to payment, the payment is really what consumers are focusing on, because 85% of new vehicle purchases are financed. The payment story is even scarier because the spread of what the maximum payments, and here I'm limiting it to just 5 and 6 year loans, which happen to be the most popular kind of loans. So I am not kind of picking data that makes the payment higher. This is actually looking at longer term loans. So when you think about that payment, when you think about what rents and housing costs today, and you think about student loan payments, you can understand why credit starts to be contained. So that's, I believe, a trend that's probably impacting every single industry, and I think at the core, it's housing related, and what housing costs basically are doing and changing what the consumer, where they can actually spend their money. So we're forecasting that new vehicle sales are going to decline this year. But when you look back historically, this is pretty normal for the new vehicle market because typically in an economic expansion, new vehicle sales grow and reach a point that basically they can't sustain that because it took everything working right to get to that record sales number. Meaning you had to have low interest rates, you had to have easy credit, you had to have all those things that made it so the OEMs can sell that number. It's not sustainable. So you see this pattern that eventually it starts to trend down. And what causes it to fall beneath that line is usually a recession. And we are flirting with that line this year, but I do believe it's really the recession that would push it down. We are officially at 16.6 million, and I think it still is possible for 2020 to see that sales, but we actually are developing a coronavirus scenario that, assuming there's supply chain disruption and a drop in consumer confidence, we think that number could fall to 16. If we have a recession, it's likely to fall into the 14 range. Probably not all in 2020, but lasting a bit into 2021. But the flip side of that is we're offsetting every decline in new vehicle sales with an increase in used retail sales. And what dealers actually make more money, so they don't mind this scenario that we're actually seeing this shift, especially the dealers who have been focusing on growing their retail used market. And so there is a positive to that, and it's a natural outcome to some of the affordability and credit concerns. But I had the foresight to dub in December 2020 the year of wild cards. And that was simply when I thought it was the election, tariffs, Brexit, and ongoing kind of trade war with China. But then we added trouble in the Middle East on literally the second day of January. And of course, February, the coronavirus started to look like it was going to be a much bigger thing. And so these episodic things, some people call them black swans, these things can totally change what the fundamental cycle can be, and actually can be inflection points. So my caution with that is throw every forecast out and try to understand how behavior might be changing. So let's talk briefly about disruption in automotive. I venture that everybody in the room can actually relate to the automotive business, because the vehicle ownership rate in this country is 91%. 91% of households own at least one vehicle. And the miles driven today are driven by all of us. 93%, according to an in-depth study that we did with consumers that were logging the miles that they traveled. And basically the disruption that the automotive industry has been seeing in the last couple of years has been coming in car sharing, car subscription, and ride hailing. That basically means that, okay, if it's car sharing or car subscription, you're driving, but you're driving somebody else's car. And ride hailing is when somebody else is driving for you, and they're driving their own car or a company's car. So the real disruption that we're focused on for the long term is actually how changing dynamics in the technology in the vehicle and how consumers get their vehicles and finance their vehicles and own their vehicle is really what's going to be dictating how the industry changes, how the finance part of the fintech part of the industry changes, how the dealerships change, because basically what it leads to is eventually we're all going to own fewer vehicles. And when you look at it in terms of miles, that 93% is going to fall. Probably not fall beneath 50%, but especially when you think about a world that we actually have full level 5 autonomous vehicles, which is the definition of the most complex AI thing that's consumer related will impact. But that's not the only thing that's influencing this. We also have quite a bit of technology now changing the actual purchase and finance process, making it a much more, I know everyone enjoys buying a vehicle and spending time in their dealership, and you want to spend as much time as possible. There are new companies that have sort of pushed the envelope of that. Carvana, Vroom as two very significant examples, and in fact Carvana's initial market was Atlanta, and they continue to thrive here. And then of course Tesla is just the leading edge of a series of brand new entrants that are not only changing the process, but fundamentally, of course, changing the technology. And so the vehicle itself is also changing, first with electrification, and then eventually to autonomous. But one of the aspects of that means that we're on a track record that if you're worried about affordability today, you don't even want to know what a vehicle is going to cost like in 10 or 15 years, because the cost of the technology gets to a point that very likely it's not going to be a scenario that the typical, especially fully autonomous vehicle is even owned by individual consumers. It's more likely to be fleet owned. So as you think about that, that really radically changes every part of the business. But it also starts to potentially address some of the aspects of why affordability and the ownership of a vehicle is so challenging, especially for younger people and people with poor credit today, because they're going to have more choices. They're going to be able to ride hail and get wherever they want at a much more cost-effective level, especially when the driver is removed from the car, and the car can be utilized because it's electric, and it can go for 2 million miles without having to have substantial change to any of the working parts other than the tires in that example. So a lot of dynamics changing, fundamentally being driven by technology. But it's interesting, everything that we've talked about today so far has been macro. It's been kind of US trends in total, and then the trends technology impact happening in automotive. But there's also major geographic differences that occur across the country. And maybe it's because I spent over 20 years in real estate, but I truly believe there is no such thing actually as a national market. Every market behaves differently across the country. So technically I think we have about 900 markets in the United States. And it's influenced by who lives there, what are the businesses there, how much it costs to live there, how is population growing or declining there, what is the demographic mix there. All of those things can radically change the behaviors. So for example, when we look at new vehicle sales, which on the retail side declined 2% for the country last year, this is what new vehicle retail sales looked like by state. So Georgia was actually down almost twice as much, more than twice as much, as the US. It was down 4.9% on a year-over-year basis. Generally speaking, though, it was the West Coast that was the worst part of the country, and the eastern half of the country and the kind of middle part of the country wasn't so bad. But if you think of it in terms of what a dealer is selling, you have to think in terms of where the growth was in used. And there the map turns way more green. And in fact, Georgia was up 4.2% off a base that's much larger. So technically, dealers sold more cars in Georgia last year when you add those two perspectives together. So you can see what a difference where you are in the country when I'm purely looking through the lens of a state. And trust me, when you drill into the individual markets, it gets even more variation in the data. And a lot of that has to do with the fundamental microeconomics of our everyday lives. So just as an example, we took from consumer expenditure data what households spend on everything by individual. This is every CBSA, so this includes micro areas in the country. And we looked at what percentage of their budget was actually spent on vehicles. And what that reveals to us is that the high-cost areas of the country, the Northeast and the West Coast, and the places that really have made most of the headlines for home prices and rents, essentially reaching a level that people can't spend, they're having to figure out how to make do with that. And one of the ways they make do with that is spending less on vehicles. And what that translates into in the automotive market is they hold a vehicle for 12 years, 15 years. Essentially, they can't afford to transact as frequently as you might see in other places. So all other things being equal, the green parts, the South and the Midwest, where the cost of living generally allows us to spend more money on other things, be it transportation, which is what I'm showing here, but you can apply this to any other scenario as well in terms of categories of business, are going to be influenced by what the real consumer's budget is looking like. And so that too translates a significant amount of the behavior that we see. So how does Atlanta, how does Georgia look like? Well, basically, Atlanta and Georgia are seeing economic growth that, by the way GDP is measured at a national, state, and local level. Our performance over the last 2 years has been under what the U.S. has seen. However, what the U.S. has seen has been influenced by some big changes happening with trade, and Georgia's actually one of the most, and Atlanta in particular, is one of the most diversified from an employment and industrial base. If you think about it and you look at our big companies here, every big company here is actually in a different industry. So we're not Detroit, that's completely related to automotive. We're not Charlotte, that's absolutely completely related to banking. Used to be apparel, but they completely have changed their stripes. So we basically haven't performed when a couple of sectors, namely manufacturing and energy, have had a killer run. But their trends started to slow down last year and actually come down for most of the quarters for the U.S. Economic growth. And instead, Atlanta and Georgia are starting to see the services businesses and professional services really more consistently deliver. So the trend actually suggests that this is the year, even if we have a recession, that Atlanta and Georgia will outperform the U.S. economy overall. And we're sort of getting back to a history of when Atlanta could often do that relative to the U.S. Overall. And the reason for that is who is here. The unemployment rate, first of all, when we look at Georgia and Atlanta, is lower than the U.S. It was At the end of last year, the data lags for local areas by 2 months relative to what we have for the U.S. overall. And the Georgia unemployment rate was 3%, and Atlanta was 3.1% relative to the 3.5 that the U.S. officially was at the end of last year. So we have an even lower unemployment rate here, and therefore, in theory, the consumer is in a stronger position. But I would argue the most important variable for growth in the future is population growth, which relates to the dynamic nature of our market. The U.S. population is growing at 0.5% at this point. Atlanta is growing 1.5%, so 3 times the amount. And Georgia is slightly less than Atlanta, but more than twice what the U.S. population growth is. And when you look at the forecasts for states and individual markets around the country, the places that are more resilient, the places that in a recession are likely to not even have a recession, are the places that continue to see strong population growth. And oh, by the way, they happen to be more affordable places that sort of related to the heat map that I showed you before. So I actually feel very strongly that Atlanta is going to be able to survive even if we see this mild recession this year. Of course, all bets are off if we suddenly have a pandemic and we're all quarantined in our homes for months, but I really don't think, based on what I've seen, that that's going to be the case. So we've got time to do Q&A. The only trick they've asked me to do is to make sure that I give you the mic if you want to ask questions. So I've got to run through the room while we do that, because of course, guy at the very back of the room wants to ask a question. All right.
And I'm from Equifax, so I saw you actually put it. So I have a question about the car buying ecosystem, because there's this new trend about the subscription-based cars where I pay monthly a certain rate and I can drive a car every day. In your opinion, how is that going to impact the car sales? Because that changes the dynamics of everything that we see today.
Yes. So subscription actually, I think, is one of the bright spots of some of the innovation, because ride-hailing, for example, seems to be hitting a ceiling right now, that it's not really growing at the pace that it was before, and a lot of it has to do with the economics of local networks and where you can get scale in individual markets. And so subscription, what is a subscription and how does it work? Well, actually, Atlanta was the home of the first real subscription platform, a company called Clutch. And actually last year, Cox bought Clutch. So I have a front row seat kind of into the data. Clutch actually changed their business model. What they did in Atlanta was building the platform, proving it could work, and essentially now they've become an enabler of OEMs and dealerships around the country to offer subscriptions. So you can no longer subscribe to Clutch. I even never had the chance to subscribe to Clutch. But if you want to do it through Porsche, Mercedes-Benz, or a variety of dealers that are all launching programs around the country, you will be able to. Fundamentally, what does a subscription do is you don't ever own the vehicle. It's basically kind of like an extended rental, but that's really not being fair to the subscription having some advantages over a rental. It's just like a rental, meaning that you're not having to wash the car. In some cases, you don't even have to refuel the car. The subscription actually covers the cost. You're just paying a flat monthly rate. It's an all-in for everything, including insurance. And but you probably, if you looked at Clutch back when they first started, or if you looked at, for example, the most successful subscription so far has been Porsche's Passport program, you might say, oh my God, that is not something that I can afford to do, because the Porsche Passport program is $1,400 at the entry level and $2,200 at the high level. And not many people I know spend that much on a single car every month, but people who own the high-end Porsches do. But the fundamental economics, and the reason why I'm bullish over it over the long term, is that the average consumer is spending way more than they think they're consuming, they're spending on ownership of a vehicle. Because the vehicle cost, there's basically 4 components that drive 90% of your real costs. The first is the actual cost of the vehicle, and financing and the monthly payment that we're used to kind of thinking of is really not the total cost. It's really the depreciation that occurs on that vehicle. So about half of the cost comes from depreciation. The second most expensive thing is typically the insurance on that vehicle. The third is fuel, and the fourth is financing. So if you take those 4 and you find a way through a platform to deliver that better than the consumer can do on their own, you've changed the vehicle ownership costs. And we've seen the math, we've seen how it works, that you can actually do it better because you're buying in mass, you're negotiating to get the vehicles more like a rental car company or a fleet company, so you're beating that one. You're managing the assets and choosing the right times to dispose of those assets and replenish them. So you're controlling the depreciation aspect, and the average consumer has no clue when the optimal time is to trade a vehicle. And then insurance and finance, don't even get me started. The average consumer does not optimize the money that they spend on finance and insurance. So the simple economics to me are compelling, and it's an antidote to affordability. And where to pay attention to this are more of these dealership subscriptions that are happening. I don't know of a significant one in Atlanta yet, but there's several in the Carolinas, Pennsylvania, and a few in Texas that basically are doing used vehicles and are delivering a vehicle to a consumer at $300 a month, all in. No commitment, meaning you can walk away from that next month when you do it. It's a classic subscription like that. And trust me, when you look at the real numbers of what consumers are spending, that can be compelling if indeed they can work out the kinks. So I actually think it'll be huge long term. Yes? Oh, I gotta give you the mic. Thank you for being closer.
Good slides. So I'm also doing some research on this one on economy of Georgia and Atlanta. But if you take a look at the GDP per capita lens, the story is a little bit different because at 2000 we used to be 110% of national level, but now we are 96%. The city is less than national. And if the comparable city like Austin and Seattle, which was the same as us, is gone higher in GDP per capita, whereas we are like 56,000 if you pin it to 2009. The Seattle is 80,000, San Francisco, Silicon Valley is 128,000, Austin is going up. So I do agree on this one, but when you take the GDP per capita, the story is not that good. But I would like to get your inputs.
Yeah, it's directly related to that huge, enormous difference in cost of living around the country. When you look through the lens, GDP is basically mimicking income, what the theoretic income is for businesses and consumers alike. And it is absolutely true that we're lower here. So are many of the other markets that have the long-term potential to continue growth. And all of the cities, I haven't looked at that particular metric lately to kind of see what the differences are, but most of them are seeing growth turn negative in terms of that being able to be sustainable. They've got some real crisis with homelessness, with what rents cost in those markets. It absolutely is reaching a point that it's no longer as sustainable. So it is an important perspective, and there's also an element of this last decade, Georgia lost ground on a lot of fronts. We were more impacted than many other parts of the country by the Great Recession. It fundamentally, I think, put us behind a little bit. But some of the good news of coming out of that and having a much more diversified economy is that it might be more sustainable for the long term. But yeah, appreciate the input on that. All right, hold on.
So you mentioned the auto subprime was going up, or charge-offs. So is that in other parts of the subprime lending environment as well?
Yes, there are some similar patterns emerging, especially with credit cards and personal loans, which has been the category actually of debt other than student loans that has grown the most. And it's actually a key reason why FICO is coming out with a new standard that's changing and including personal loans for the first time later this year, and will be changing, probably making people, if you draw one conclusion on the FICO methodology change under the 10 methodology, it's likely to make the best credit people better and the worst credit people worse because of the behavior, the additional view of the personal loans and the behavior that's more trended over time that comes out of those scores. So it's kind of, it'll reveal more vividly that we have consumers living on the edge, and debt has been a big part of that.
Is the subprime population growing or shrinking?
Subprime population has been shrinking, but some of that has been the economy's been stronger, but some of it is also that maybe the metric wasn't keeping track with the changing behavior of debt, and so let's wait and see what the new FICO comes out, and let's actually see if that's still the case. But today, roughly, subprime is 20% of the U.S. population, or at least the subset of the U.S. population that has enough data to have a credit score. But I think 20% is a good number. And I think, did I get the?
Yeah, that's the time. Sorry.
All right. Well, I thank you for attending. I hope you will agree it's the best session to have been in. And have a good rest of the conference.